Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Hi, Don here. Tom and I are taking a little time off to spend with family. So, in our stead, we're presenting some lost archive podcasts. These are podcasts that they were up on the web many years ago, and then when we changed podcast services, these vanished, and then they were found again. So many of you, most of you, almost all of you have not heard these podcasts. These date from back in the summer of 2017, which is when I was traveling across the country, and we did the shows, well, often we did them with me on remote, in remote locations, but they worked out well. And the great thing about these shows is that they show how consistent our advice has been over the years. However, there are some things we talk about that are very dated, like events we're holding or offers we have or whatever it might be. The disclaimer is a little outdated, stuff like that, because this episode's from back in 2017. So have a great holiday. Enjoy this episode. Thanks so much for listening, and we'll talk to you again soon.
Reality radio for a really great future. We're talking real money.
And I think they're burning real money right outside the door.
Wow.
I tell you what.
Talk about blowing smoke.
Yeah, I got smoke in your eyes. I got all kinds of songs. We could just go on and on and on. It'd be a long show.
Oh, hi there, everybody. You know, it's funny. I left Florida. I did. I left Florida for the cooler climes of the Pacific Northwest.
How's that working out?
And of course, I was hoping for smoke-free.
Yeah.
I thought they banned smoking
I
in
know.
Seattle.
Apparently somebody's lit up something and they forgot to put it out or something. I don't know.
That's right. You have that other smoke.
The other smoke
now.
that's drifting over the city. You can't even see the Space Needle anymore.
I'm surprised I'm not getting a contact high then.
Yeah. We can't drive home for 4 hours after sucking in this much air. That's for sure.
That's the truth.
Yeah.
Hey, everybody. Welcome to the show. I'm Don McDonald. That guy over there is Tom Cock. This is a program specifically and scientifically designed to create better futures for you. Yes, you. Without the need for opacity, without the need for complexity, and without the need for outright lies. We're here to tell you the truth about making money, how you make money, and how you use it to build the best possible future you can enjoy.
Not like one of the things you say regularly. Money, it's a tool. It shouldn't be like a thing that takes over your life. I was talking to my son about this on the vacation because...
By the way, yes, ladies and gentlemen, Tom just returned from a vacation at beautiful, even smokier Lake Chelan.
There's some smoke. I mean, you couldn't see the other side of the shore.
And it's not that wide a lake.
No. At that point, we were like, I think it's time to... get out of here. But he was, and because you've been to the place, I spent a lot of money on that. I mean, it's a very nice place. It's on the lake, et cetera, et cetera. But I do that because the whole family comes. It's kind of a bonding thing. It's great.
So you got to drive back with your son, I heard.
Yeah. Yeah. Are you going to go into that? Yeah. You had to hear the life story. But the point was...
money.
The point was, I spend a lot on, but money, and he even said, well, because it's a tool to create something that you really enjoy. It's not the overarching point of my life. I don't wake up every day thinking about it. We've had this discussion before.
I don't either.
Yeah. We read about it, we talk about it, we help people with it, but we think it should be a small part of your life that supplies the what you need to take care of yourself and those you care about.
We're big fans of putting this all in perspective.
Yeah, that's the word I'm looking for.
Money is a means by which you enjoy certain ends. It's a tool.
Exactly.
And we want to help you use that tool better because it is a very powerful tool. Possibly the most powerful tool, which is why there are so blasted many people wanting to get their hands on it. So that's why we do this show. And as a matter of fact, a little later on in the show, an egregious example of people doing anything they can to take your money for their purposes. Just This goes on and on and on. So one of the things we would like you to do, we got a couple of things going on today, and I'll tell you about some of those. But one of the primary purposes of this show is to help you do right starting today, to avoid getting ripped off, or if you might have already gotten into something that isn't in your best interest.
Can you say annuity?
Yeah.
Pardon me.
Yeah.
Choking there.
Indexed annuities, variable annuity. Just call us before you get involved.
They're as thick as the smoke out there, Don.
And the problem is, we can't say this enough. Call us before you get involved.
Whatever you've done, we're happy to help.
Yes.
Try and help you escape.
But it's easier to avoid cutting.
Yeah, that's true.
It's easier to avoid cutting the limb off than sewing it back on.
Well, God. Yikes! That's very graphic.
Well, but it's part of you. It's like a limb. When
That's true.
When you lose $250,000 or $100,000 or even $1,000, depending on your perspective, to some of these idiots, it's gone.
I still like the number 1% difference a year over a 30-year lifetime in a 401k. 1% a year.
Yeah.
35% difference in how much money you have at the end. Do you want a third more, or is that not a big deal? That's kind of a big deal to me.
Bit helps.
Yeah. So anyway,
we would love to help you deal with money issues. The
Don
stock market,
is beating up
market.
on the Dow Jones Industrial Average.
I'm not really beating. I'm trying to put this in perspective because I don't think the vast majority of listeners have a clue about what these index quotes mean. I don't think they have a clue, and the Dow doesn't mean a thing. It means nothing.
Well, unless you're one of the Dow 30.
But it doesn't mean anything in terms of the stock market. And in a couple of minutes, I want to put all this in perspective and talk a little bit about how you should invest based on some of this. And before we do that, Krissa, you're up. Welcome to Talking Real Money.
Hi, thank you for taking my call.
Glad you did it.
I have a question about 529s. I am interested in them for my son. However, neither my husband or I went to four-year college. So I'm just wondering if there's other ways to save for college that I could get my money out if my son does not end up going to college.
Yeah, I mean, my advice there, if it was marginal, let's put it another way. If college might or might not happen, then you could do Uniform Gift to Minor Act. You could do regular a brokerage type of account.
However, any kid, whether they go to college or not, would be wise to have some post-secondary education
of some
kind under their belt. Let's say, for example, your child decides that they want to go into a trade.
Yep.
It would make sense for them to at least spend some time in a trade school, getting schooled on the trade. It improves their skills and salability in the market. And 529 money can be used for those types of education, for that type of education.
So again, you could, if you want, you could do Uniform Gift of Minor Act. You could just do a regular brokerage account. You just open an account at Vanguard, put the money in there, and then when you sold those securities, like a mutual fund, you'd simply pay the capital gains tax on that and give them the money, and they could go use it for something else.
And one of the advantages to giving it to the child under the Uniform Gift to Minors Act is the fact that any taxation is at their rate. And most kids, when they're coming out of high school, aren't exactly in a high tax bracket.
Yeah, most.
So do a little bit of both. Go do the Utah 529 for some of the money to get the tax advantages today. Do a little bit in a UGMA account, Uniform Gift to Minors Act account for the child. Just let them know they're not allowed to, go frivolously spend it, although they can if they want to.
Yeah.
Just kind of build that into their lifelong.
By the way, here's another thing to
training.
think about.
Yeah.
In your big picture family planning, you can take that money in a 529 and give it to somebody else in the family. We got a situation like that in my life that we're going to do that.
Even a grandkid down the road. So it could sit there for a grandkid. We are talking about your life and something really important.
Tom and Don are talking real money.
Quick break. In addition to our Talking Real Money podcast, we have a few other tools to help you gain a better understanding of the concept of real investing. Of course, there's Real Investing Journal. That's offered in both a free online version and in an inexpensive printed magazine. Explore both those options at realinvestingjournal.com, realinvestingjournal.com. Then we teach classes. We offer most of our live classes in the Seattle area because that's where most of our offices are, but most of you live elsewhere. That's why we're now offering the same classes that Tom and I taught at Retire Meet online right now, free at TalkingRealMoney.com under the video link. Just go to TalkingRealMoney.com and then click on the video link. You'll see them right there. Finally, we also manage the wealth or the budding wealth of hundreds of folks like you through our fee-only 100% fiduciary investment advisory firm, Vestory. You'll find our approach is consistent with the message we've been sharing for decades. We always put our clients' needs first. Our fees are among the lowest of any non-robo advisor, and constant education is one of our core values. Visit Vestory.com for more information on our firm and to take our free no-obligation risk quiz to better understand the level of investment volatility you can tolerate. That's Vestory.com, Vestory.com.
Reality radio for a really great future. We're talking real money.
Quite possibly the way that most people get to a comfortable retirement is by investing, and usually that investing includes a little investing in the stock market. That's why today we have a special topic, which is the stock market. What is it? How does it work? How can you use it to improve your future situation? And why is it so blasted confusing? I'm Don McDonald. Tom Cox over here next to me.
I was talking to my son a little bit on my ride home about the conflicts I've had on the air with people. Actually, where they were like really angry with me. And he was shocked.
Oh, you're talking about your TV show?
Yeah, where people actually sat there and really got into it. And
yeah. By the way, for those of you who don't know, Tom used to be on the.
Oh, I hate that used to be thing.
It is used to be.
What
are you still there?
I know. I know. I'm just saying I hate it. I didn't say
Back
it's
in
not
the
true.
olden days.
Yeah. Back in the day. Yeah.
Tom was on PBS in the Northwest doing a show about money.
So we don't get very much
CEOs.
conflict on this show because people, I think they're afraid to do it, is my take.
Excuse me. Maybe
Would you like another shot of smoke there or something, or what the heck?
They're afraid of us.
No, they don't. I think they don't. They don't want to do it. So anyway,
Well, I keep hoping.
we've had a few. I think we've had two.
Two.
Yeah, they've actually called and said you guys have got this all wrong.
And they're wrong.
But anyway, we've had so.
But I'm welcome to listen.
Yeah.
I mean, they're welcome to call me and try
Yeah.
to convince me.
Well, true.
Tell me why. In fact, this question will just stand forever. It has nothing to do with stocks. All of you who sell indexed annuities, all right? I want you to call. If you think your product is honestly good for people, I want you to call me.
All right, now I'm going to have my General Kelly moment. We got to get back to the market. You're veering here. You're going off course.
I just want him to call me.
Because you're trying to help people understand what investing
I am the
in
Donald.
stock. Good point. Investing in stocks.
Yeah.
Right. I mean, so when you invest in a stock, any stock, Dow Jones 30, S&P 500, Dow Jones World Index, you're putting your money into companies.
Yeah.
That's why they're called equities, by the way. That's why it's because it's equity in a firm.
Right.
So what you're doing is you're hoping that firm, the price of that security, which reflects the health in some ways of that company, or there's other factors.
Really, what it reflects, and this is boiling it down to its simplest. The price of a stock reflects its current and potential future earning. How much
information
money
that relates to that. Yeah, I mean so what you're doing is you're exposing your money to those securities, right? You're putting that's completely different, by the way, than buying a bond mutual fund. Completely. People confuse it. A bond is an IOU at the end of the day.
Right.
There is no such thing when you invest in stocks because some stocks
don't owe you anything.
They owe you. They could go out of business tomorrow.
Well, okay, technically you own a fractional percentage of the company's assets.
But when that company goes to zero, you're not in a great place if you're a common stock holder.
Right. You're kind of last in line.
You're last in line. So, but a bond, on the other hand, especially the type of bonds we would have you own, short and intermediate term U.S. government, have paid you back and with a small amount of interest. So those have made less over time than stocks at the simplest.
A lot less.
Well, yeah.
Because they're not. We were just looking today at the Schwab
SCHO
short-term bond fund.
Yep.
And its volatility volatility is a means by which you can measure how scary something is. And its volatility was almost as close to zero as you can get.
Very low.
It just doesn't fluctuate. Does it make you any money? No.
Hadn't made you much. 1.9% year to date.
It was less than that.
Oh, no, I'm thinking of the Vanguard,
it was
the short-term
like
investment.
0.6%.
of 1%.
Really low.
Yeah.
So but that's why we own stocks. Stocks are in a portfolio because stocks have this ability to grow more valuable, and it is not a shell game. It is not a zero-sum game.
That's what people think it is.
It is not that.
Yep, I
what
won,
you are
lost.
buying is one little. When you buy a stock, you're buying one little sliver of the global economy, and I mean a tiny sliver. JD, you're up. Welcome to Talking Real Money.
Good day, gentlemen. How are
JD.
you?
Good. Thanks for the call.
Oh, you're very welcome. Thanks for taking it. I have actually two questions because I thought of another one while I was driving here. The first one is the one that I mentioned to the screener, and that is there anything to the new, fashionably fantastic, up-and-coming pot stock?
Okay, well, let's take that. Should we take that one first, or we better because what we've been doing?
With all this smoke, we might forget what the question was.
Exactly. All right. Yeah.
Good point.
So you want to know, should you invest in pot stocks, right?
Yeah,
That's the question.
I think the underlying question is,
I mean, that's what people
whether
want to
there's
know.
a good one or not, should I invest in pot stocks?
By the way, I think I shared this once on the air. You know the what's the investor show? I always forget the name of it because I hate it so much. Money shows. Their whole focus,
the money shows,
their whole last focus was
them.
on pot stocks.
Yeah,
that was the invest in cannabis. Well, okay,
because it's trendy.
Yeah.
Right.
The answer is
it's trendy.
Trendy. The answer is
it's trendy.
Yeah, okay, here's the thing. When these companies go public, and I don't know that there are any publicly traded.
Yes,
are there? Okay.
There are some.
And you own an index?
Yeah,
you own some.
At least a dozen.
Okay,
Yeah.
you own them because they're going to be part of whatever index they're a part of. I would not run out and buy it as a sector. No.
Well, let me take it one step farther, and that is, if you put money in pot stocks, you are truly not investing any longer, or in any individual stocks or even segments of the economy. You're no longer investing, you're betting.
Yep.
You're betting that pot stocks are going to do well in the future. And I'm not saying they won't.
They'll go really high.
Right.
Yeah.
Funny, sorry. Or they might go up in smoke.
Yeah.
No.
Funny.
Okay. I'll try.
Not really. I have to say that to Tom because I'm in the studio with him right now instead of 3,000 miles away.
Good point.
I get slapped upside the head.
Cheech and Chong reference there. That's good.
I thank you.
A little bit of that.
Right.
But here's the deal. It's a pure, unadulterated speculation. And your odds of success are not a lot greater than your odds with any other gambling that you might do in life. Because how do you know of the dozen or 24 pot stocks out there, which ones will be survivors? What if none of them are? What if down the road Altria or someone waltzes in and buys everybody up for a song and they make all the money? The other thing, you have to think of all these potential pitfalls. Let's say the Justice Department says we're going to start nailing them on a federal level.
I think Sessions just said something about Washington's law the other day.
Risk is out of sight.
Yeah.
Now, if you own a globally diversified portfolio, you're going to have 1/100,000th of 1% of your money in pot stocks. You're going to. You're also going to have a little bit of alcohol. People drink.
Yeah.
You're going to have vacation destination. You're going to have all those things. This is gambling, and I am totally opposed to gambling unless it's money that you are absolutely 100% convinced you can lose. And if that's the case, then I got to tell you, your guess is truly as good as my guess.
Okay.
Okay.
I'll take that. My second question, and I hope this is an appropriate one for you guys. I'm in the process of trying to buy a house.
Okay.
And, of course, I'm having all sorts of people come at me with all sorts of different, here's how you buy a house options in terms of, bank loans and mortgage brokers and home loan agencies, et cetera. And I'm kind of lost when it comes to the difference and if there's a big savings one way or the other between a 30-year and a 15-year. I know there's a lot of other options, but I'm kind of starting small and thinking
No,
just
that's
in those-
actually, you should
That's a
start
good
there.
question.
You should start there, and you should probably end there, because when you take on a variable rate note, an adjustable rate note, you take on additional risk. And I got to tell you, even though I don't predict interest rates, while they could go lower,
Generally, you gotta
how
expect
much
them to go
lower
up.
than zero can they go?
So what you're saying is do the
a 15 or a
30 fixed.
based on
Because rates are so low today.
Yeah.
I mean, why do you need a variable rate anyway? But here's then the term.
Right.
15 or 30.
15 or 30.
Again, I don't know your situation, JD, well enough to say do one or the other, but here's something to consider. You can always do the 30 and then pay it off sooner. You
Yep.
can just pay down principal.
flexibility.
So payment's going to be lower, et cetera, up front.
But let me throw a but in there.
Yeah.
15-year rates tend to be
They're going to be a little lower. Yeah, they're going to be lower. Yep.
So if you know going in that you are going to pay this house off in 15 years, you absolutely know it, you know you can afford to do it, then you take the 15-year and you take the fractionally lower interest rate. If there is any ambiguity,
Yeah,
it's
that's
like,
true.
I don't
Maybe.
know my situation. I could use a smaller payment right now, but down the road, my income's going to rise. I got to afford a bigger payment. Then you go with a 30-year. But bear in mind, you got to go fixed. The risks, again, are too high to play with this kind of money.
And don't get gamed into a bunch of other silly. I see all kinds of weird offers out there around this stuff. I wouldn't do that.
It's simple, and then you shop price. You shop price. The interest rate, the bottom
There's still some
line
great
numbers,
deals, yeah.
and everybody who's worth their salt will give you, as a matter of fact, they're required to give you a good faith estimate of all of the expenses and costs, the bottom line number. That's what counts.
Yeah.
All right?
All right. Thank you. Appreciate it. Have a great day.
Go get them,
Thank you.
JD.
Yeah.
Thanks for the call.
And by the way, next hour is the Bong Show. We had the Gong Show and then Bong Show next hour. So
Did you watch the new Gong Show?
I did not.
Okay.
Is it bad?
No, it's actually so bad it's good.
Okay.
Because
Who
what
was the
they
guy who did it? I forget.
Mike Meyer.
No, Mike Meyer. Oh, I didn't know the new
Meyer,
one. I'm talking about
and
the old guy.
In the new one, Mike Meyer plays a fictional British washed-up television host.
Oh gosh.
Who, as his last gig possibility on the planet, got hired to do the Gong Show in America.
I see. Hey, that sounds like a good lead-in.
He wears Mike Meyer wears makeup so thick that sometimes you go, is that really him? He becomes this whacked British guy to
Transformed.
the point where he has a picture of the Queen and a British flag and all the little accoutrements.
And then he has
on
actual
stage.
acts that come in and try to do. Okay.
They have some acts that are real and some acts that you know they just went out and made up.
Yeah. Okay.
And they bring on
Chuck Barris.
Chuck Barris.
Oh, he did the original.
But they bring in stand-up comedians to be judges.
That's perfect.
Which makes the show very funny. Cindy, you're up. Welcome to Talking Real Money.
Hi, Cindy.
Oh, Cindy?
Thank you.
Hi
Yes.
there.
Can you hear me okay?
We
Yes,
can.
ma'am.
Go ahead.
Okay. About 3 years ago, I was laid off work. I'm 60 years old. And at that time, I had about 5 or 6 different 401k plans, and I consolidated everything at brokerage. I don't know if I can say the name of it or not.
We don't mind. It's
Go ahead.
Okay.
First Amendment stuff.
Okay, Merrill Lynch.
I've heard of them.
Yeah.
Have you now?
Yeah.
Turns out.
So,
No bull. I'm
Yeah.
sorry.
My jokes were bad.
I can use bad puns just as well as he can.
All right,
Yeah, go ahead.
So, what I'm wondering is, was that not a very good decision? What kind of fees should I be looking at? Very general question.
Yeah, I would go. By the way, my starting position on all this would be number one. What is your relationship with that firm?
There you go.
That's the first thing you need to know. So, if, for example, are they acting as a fiduciary? In other words, are they legally required to put your interests ahead of their own?
And let me explain what that means. Are they managing your portfolio? Did they create a portfolio and then they modify it, they rebalance it, they do things to it over time? Are you in an advisor relationship with them or a stockbroker relationship? Are they just picking stuff and letting it run, or are they actually advising you on the portfolio?
I would put it in the second one,
Okay.
advising.
Okay, then I can tell you exactly how much money do you have with them?
I
Ballpark.
would say approximately $500,000.
You are paying, currently they reduced their fees from 2.7% per year to 2.25% per year.
And then
Plus-
there's the cost of the investments you're in. Are you in mutual funds?
Mostly mostly mutual funds, and some of the funds that I had in my accounts, we just transferred them over and leaving them as is, and so there's no charge on those.
No. That's not that there is no charge. There is no commission.
Yeah.
But there are charges internal to the funds. Give me the name of just one fund that you can remember.
Can you name one mutual
Just
fund you
one.
hold?
Oh, God. Vanguard.
Good for them. Good for them.
It's a life strategy.
Okay, good.
Okay.
Good.
Figured.
Okay, so what you have, for example, in a Vanguard Life Strategies fund, you're probably paying about 2 to 3/10%.
I'd say 3/10, yeah.
3/10. So you're paying in total, let's just say for that portion of the portfolio, you're paying Merrill 2 1/4, and you're paying 0.3 to Vanguard, so you're paying about 2.5% in total fees and expenses. In our opinion, this is where we don't like the model of the brokerage industry, and this includes Morgan Stanley and Ed Jones and all of the big brokerage firms who are going to this advisory model.
Because they can say they're a fiduciary.
Too much.
Yeah, it's too expensive. Too much.
The highest fee you should pay on a portfolio of under $1 million is maybe 1.25%.
Yeah,
Really,
that's
we'd
high.
rather see 1 or less, but 2.25 is just too much. The quarter would be good. It's not 2 1/4 too much. It's too much.
Might
So,
look at your relationship
yeah,
carefully.
I would consider that.
Are talking real money.
We hope you're enjoying one of the more unique podcasts out there, but we want to remind you that there are other tools we offer to help you get educated about what we call real investing. We publish Real Investing Journal both as a free online version and in an inexpensive printed magazine. You can check those out at realinvestingjournal.com. Then we offer classes, most of which are in the Seattle area, but now we've got a couple of the classes that we taught at Retire Meet online for free at talkingrealmoney.com under the video link. Just go to talkingrealmoney.com, click on the video link. And finally, we rarely mention it, but we also manage wealth for hundreds of folks and well over $250,000 through our fee-only 100% fiduciary investment advisory firm, Vestory. We manage money just as we talk about it. We always put our clients first. Our fees are low, and we educate you on a regular basis. Go to Vestory.com to learn more, and you can take our free no-obligation risk quiz to understand the level of investment volatility you can tolerate. That's Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And Cindy and everyone else listening, if you want to vet your advisor, and you, by the way, you should vet your advisor. You should never, ever, ever just walk in and sign the papers and start a relationship with someone.
Even if you really like them and they're nice people.
And they're always nice people.
Really?
This is every advisor. And I'm talking about us or any other advisor you ever talk to. Go look us up.
Yep.
I'm serious. Go look us up. What you do is you go to Advisor Info, and it's with an ER because the government spelled it. Advisor Info.
No, that's how we spell it too.
I think it's OR.
We're supposed to spell it ER. But anyway, whole separate thing.
What is there?
I don't know.
Both are right.
I know.
Advisorinfo.sec.gov.
Yep.
Advisorinfo is one word. Advisorinfo.sec.gov. Then click on the firm button. The button that says firm. It's not a firm button. They're both the same. Softness.
You're really funny today.
Don't hit the firm. Okay, hit the one that says firm.
Yep.
Type in your firm name. Type in Vestory or Merrill Lynch or Smith. No, they're not around anymore. Or Morgan Stanley or Ed Jones or America, whomever. Type it in. Go to their ADV, means Advisor Form Part 2 brochure. Click on that and go to the fee section.
To tell you how much you're paying.
Go to the fee section. They are all registered investment advisors in the country are required by law to publish this thing and to disclose in clean, crisp, concise English.
That came about 5 years ago.
Yeah.
Some of it is.
Some of it isn't yet, but tell you what all their fees and what their conflicts of interest are.
Well, no, I mean,
that section can be fascinating.
Well, and I love the fact that the major, I think Merrill Lynch is one of them, where they're adding a robo service. But if you want to have your mutual fund to be part of the robo service, you got to pay to play.
Yeah.
Do you think there's a conflict there? Come on,
And
really?
it'll be in their conflict of interest section.
Right, it'll
They
say it,
have
but
to
it's
actually put it
but
there.
nobody reads that, and you can't
Read
buy
it.
It's drives me crazy.
Read it. This
Yeah.
is actually a lot easier to read than most disclosure documents.
Well, that's true.
Because it's in plain English. Victor, your turn. Welcome to Talking Real Money.
Yes, I have a question on I've got a few variable annuities.
Okay.
What is your question?
Well, I'm actually being offered to surrender them because the one I have is with Voya.
Let me guess why.
Oh, I don't like FOIA.
But let me guess why. Go ahead, tell us.
Okay, so they first have a contract value, then they have a MGIB benefit base,
Mm-hmm.
and then they're offering a enhanced surrender.
Because they have a new product that they'd like to move you into.
Right?
I hope not, because I was kind of hoping that this one would be one that would pay me roughly 4%, let's say, annually, because of the guaranteed benefit of this one. It's kind of like the hybrid.
Yeah. Well, okay, so why are they telling you to get out of it?
I guess they are looking to get out of the annuity business.
No, they're not.
They are not. They're just looking to change to another annuity.
Yes, they are.
Yes.
Do you
they're
know
gonna
why?
Take a guess.
They can make more money.
There's a new commission on the sale of a new annuity.
Right.
How
But tell
long,
us- yeah,
how
go-
long have you had this
Yeah.
annuity?
I bought three different ones. It used to be ING, and then
Yep.
they were bought out, turned into Voya.
Well, they just
So I
changed their name to
They didn't
Voya.
buy them out. Yeah, same company.
Yep, they just changed their name.
It's a
So-
Dutch company.
Okay, and I bought this one in 06,
Mm-hmm.
and I'm 59 and a half.
Do you know why they're doing this? This is
just
so
horrible.
typical.
Yeah.
The surrender charge has run out.
Yep.
Okay, right? So now
Yeah, but they're gonna
you've
offer me
paid
another
them.
one, I guess.
You have finished paying off their commission from when
So
they
guess
sold it
what?
to you the first time. So
Yeah.
they're just desperate to get to rock and roll you out of another commission.
It's kind of like if you remember back in the late 90s, the
called
whole
churning.
the refinance thing where they'd call you every 3 years and go, hey, your rate was 7, but we can get you to 5. They don't mention the fact that they have all these points they want to add on to make money.
Yeah, I've been looking at that on a refinance.
Yeah, so our
Because I don't owe that much left on my house.
But tell us, to step back to tell me why at 59 and a half you feel like you need to annuitize this money.
Well, this is money I did 10 years ago. So I was wondering, should I just keep this thing or should I sell it and maybe buy into a mutual fund?
Okay.
Now we're talking.
Now we're talking. How much money's in this annuity that we know now you don't have a surrender charge on?
No. So what they have is they if I did the enhanced, they would pay $80,000.
I would run from Voya as fast as my legs could carry me.
Which, frankly, isn't that fast. But he'd run pretty fast in that
Oh,
circumstance.
I would, and I'm old. I would get. I do not believe. One, I don't believe variable annuities are great investments. They're incredibly expensive. The internal expenses are high. The amount of money you make on them is low. They make the person selling them a lot of money, a ton, probably somewhere in the range of 8%. Huh?
Right. Yeah, 7 to 8%
Yeah.
probably. Yeah.
Yeah. And all that's money that really could just be working for you in your retirement. You're 59 and a half. Do you need an income from your money right now?
No, I'm going to work for another 7 years, so I would like to put that into something. So that's why I was thinking if I did do this, I would put it directly into like a mutual fund.
Yep.
Yes.
Yep. I would.
Is this retirement money? Was this like a IRA?
No, I actually have IRAs too. I have
Okay.
Roth IRA
So
that I put in.
this
every
is tax
month.
money.
You put a Roth IRA in a variable annuity product?
No, I
Okay.
I do American funds.
Okay.
Okay. I was going to
You
get
need-
really mad.
One,
Anyway.
Roth. The
Yeah.
Roth needs don't do American funds anymore because it's a 5 3/4% commission. Don't do that.
Okay.
Now this is annuity. You can get out free and clear. Hallelujah! You have reached your own personal Independence Day. We need fireworks. You need to run as fast as your legs can carry you again in a new direction. This time you need to go either toward a fee-only advisor, or if you think you can do it on your own, go to Vanguard.
You can own a couple of funds there that are pretty inexpensive, and you own one stock fund, one bond fund, and that's kind of it.
And Vanguard funds are no load, no commissions, none. No hidden commissions, none. And the fees, get
So
this.
it would be best to probably take, like, let's say that's $90,000 and
Yeah.
split it half between a bond fund with Vanguard and one
Sure.
of their blue chip mutual
No.
funds.
No, okay. Here we're going to do this again. First, I want you to go to our website. Go to talkingrealmoney.com and take the risk quiz.
Oh, that's a good idea.
Determine what your risk tolerance
It's
is
free,
first.
by the way, and
It's
there's no
free, and
obligation.
we don't call you. We don't do anything with that. Do that. Take that. Then, once you've determined what your risk tolerance is, it may mean that you're 60% in stocks and 40% in bonds, or 60% in bonds and 40% in stocks. But the mutual fund you should use for equities, because you want the best diversification you can possibly get, is the Vanguard Total World Stock Index.
VTWSX.
That's its symbol. Look it up online. It's about 7,500 stocks, incredibly low fees, massive diversification. You then rebalance whenever you get out of whack and let it ride until it's time to start taking money out and become more conservative if need be with age. Take that risk quiz again and again and again if you need to.
Tom and Don are talking real money.
Quick break. In addition to our Talking Real Money podcast, we have a few other tools to help you gain a better understanding of the concept of real investing. Of course, there's Real Investing Journal. That's offered in both a free online version and in an inexpensive printed magazine. Explore both those options at realinvestingjournal.com, realinvestingjournal.com. Then we teach classes. We offer most of our live classes in the Seattle area because that's where most of our offices are, but most of you live elsewhere. That's why we're now offering the same classes that Tom and I taught at Retire Meet online right now, free at talkingrealmoney.com under the video link. Just go to talkingrealmoney.com and then click on the video link. You'll see them right there. Finally, we also manage the wealth or the budding wealth of hundreds of folks like you through our fee-only 100% fiduciary investment advisory firm, Vestory. You'll find our approach is consistent with the message we've been sharing for decades. We always put our clients' needs first. Our fees are among the lowest of any non-robo advisor, and constant education is one of our core values. Visit Vestory.com for more information on our firm and to take our free no-obligation risk quiz to better understand the level of investment volatility you can tolerate. That's Vestory.com, Vestory.com.
And people get
What?
Victor raised an interesting point because he gave the money to the insurance company.
Right.
What he heard was 4% guaranteed a year.
Yeah.
So with that in mind, and people, well, that's good. I'm going to be okay. I'm going to make 4%. Mm-hmm. Number one, are you really making 4%?
Well, you might.
You might.
You might.
Number two, he had himself said, hey, the guy selling me this is making 8%.
Yeah.
Do you think the person selling you that for 8% is incentivized at all by the commission? Or is it, this is...
I got to tell you, at least I'm a little bit proud of the Voya people for at least waiting until the surrender charge was up.
Oh, I love it. I love it.
You know?
By the way, we've got this other thing.
Sometimes they'll say, pay the surrender. I got a better product. Yeah. Okay, let me just tell you real quickly why I generally hate variable annuities.
Hate's a very strong word.
Well, I'm a very strong person.
Okay.
Emotionally, not physically. I do not like them, Sam, I am, because they, one, are horribly missold. They are sold as tax-deferred investments.
Mm-hmm.
Yeah, not really. Okay, yeah, you don't pay taxes on the growth in the portfolio's value.
But when it comes out...
If there is actually growth in the value.
Yeah.
But, when it comes out,
guess
how
what?
is it taxed?
I think it's your regular income tax rate.
Dun, dun,
Shocking.
dun. So,
whereas if you put it in a mutual fund and it went up and you took it out and you had gain in it, you would be paying capital gains
rate,
which generally is less than...
Well, it's about 15% or
yeah,
less.
well, generally it's less than the regular income tax rate you're paying. So it's not a tax benefit.
Then these variable annuities are designed specifically for obfuscation. Look it up. It means confusing the heck out of you. Blurring the reality. Opacity.
Yeah.
They are designed to confuse you with all of these little riders and fees, all of which make the insurance company more money. Sometimes those riders and fees, I've seen policies where those riders and fees are almost 5% per year. Then they have, they'll tell you, there's no commission. I have the key to discovering what the commission is. Always ask anybody who's about to sell you an annuity. I sound like a robot, got stuck. What the surrender charge is. Because whatever the first year surrender charge is,
that's what they collected.
That is the commission that the
and we've
firm
seen those as high as
12.
Oh, again, so
12.
We don't.
Percent.
Yeah.
Of your money.
So would you have made more just owning 2 mutual funds at Vanguard, for example, over the long haul?
Well,
I'm going to say yes.
Let's see. He got in 2006.
Yeah.
And
Say he made 4% a year.
No, he made more than that, though. I mean, in a 50-50 portfolio between 2006 and now, he probably, and that's off the top of my head, probably made about 7%.
Yeah, because you had the big decline in 08, 09. You come back.
7 or 8% per year, which over that time frame is a double.
A lot of money, right. Rule 72.
That's a double.
There you go.
So, again, I don't like them because they're I really don't like them primarily because of the way they're sold.
That they are sold. I mean, gets back.
Why do they exist?
Right.
They serve no useful purpose except to make the insurance industry money. They serve no useful purpose.
All right. I want to mention very quickly that coming, I think it's 2 weeks from today.
Oh, yeah, the open house?
Open house. We haven't been really promoting this, but if you'd like to come and meet us, see the show.
We're going to be doing the show live from our new offices,
which are amazing. And I got to say thank you to Don because he designed them. He and his wife were over there putting them together this morning. It looks beautiful. It's fantastic. So if you want to come and join us, 11 a.m. to 3 p.m., we're going to have food trucks there, the show there, meet and greet. You get to see the new office.
Right.
Hey, nice deal.
And to get your tickets, because we're giving you food truck food, so you got to pay for it.
Yep.
You're not getting anything. There's nothing free. We're going to give you food truck food, but you got to buy a ticket. Go to TalkingRealMoney.com.
Tom and Don are talking real money.
We hope you're enjoying one of the more unique podcasts out there, but we want to remind you that there are other tools we offer to help you get educated about what we call real investing. We publish Real Investing Journal both as a free online version and in an inexpensive printed magazine. You can check those out at realinvestingjournal.com. Then we offer classes, most of which are in the Seattle area, but now we've got a couple of the classes that we taught at Retire Meet online for free at TalkingRealMoney.com under the video link. Just go to TalkingRealMoney.com, click on the video link. And finally, we rarely mention it, but we also manage wealth for hundreds of folks and well over $250,000 through our fee-only 100% fiduciary investment advisory firm, Vestory. We manage money just as we talk about it. We always put our clients first. Our fees are low, and we educate you on a regular basis. Go to Vestory.com to learn more, and you can take our free no-obligation risk quiz to understand the level of investment volatility you can tolerate. That's Vestory.com, Vestory.com.
Reality radio for a really great future. We're talking real money.
Hi, I'm Don. That's Tom. This is Talking Real Money, the show devoted to giving you a great chance at an incredibly bright future because you need money to enjoy life down the road. And we're here to help keep you from being taken advantage of by the industry.
Yeah, and the industry is, I hate to say it, full of charlatans at the end of the day because, they prey on you. I mean, it gets back to a little bit of about what Victor said. I just wanted the 4%. I don't want to, I get the sense from Victor. I don't want to worry about markets and all. I don't want to have to learn all that stuff. I just want my 4%. And that's what people, they get trapped into, I think, with a lot of annuity products.
They also just get plain old misled. Yeah. Like a bunch of folks who went to a website for what was called the Federal Employee Benefit Counselors. It's a website.
That sounds very...
It sounds official.
Yeah, it does.
In fact, let me go to their website here.
Federal what?
Federal Employee... I wonder if the website's still up.
I'm betting it's not.
It is.
No.
Oh, yeah. There you go. Yeah.
Oh,
look
isn't
at
that pretty?
Look at that.
Yeah.
Federal
Be
Employee
clear,
Benefit
be confident.
Counselors. It's myfebc.com.
Don't go to this site.
Yeah, no, go. It's all right. It just tells you what to avoid.
Yeah.
What they make it sound like is an official government site. It has an official-looking seal, and you'll find
testimonials
from people saying things like, this service is the best-kept secret in the government.
Because it's not in the government.
Part of the government. It's a bunch of insurance salesmen in Roswell, Georgia, who are trying to, and are succeeding, in part, to convince people to turn their, get this, Tom, their thrift savings plan.
With some of the lowest retirement plan expenses in the country. Maybe the lowest.
Variable annuities.
There really should be a law here.
Well,
if there's not, there should be.
4 of the people, I think it's 4, have been called on the carpet by the SEC. The SEC has accused 4 of these insurance brokers of fraud for persuading about 200 people to move their money out of the TSP
200 people, wow.
and into expensive annuities. Now, the company is claiming
they didn't know
that they're being targeted by the federal government to protect the TSP.
Huh?
No, seriously.
Wait a minute.
The company is claiming that the SEC is targeting them because they're trying to protect their own savings plan against private plans that could be just as good for people.
Well,
liar,
yeah,
pants on fire.
Boy, I hope they got good lawyers to work that one because they're going to need them.
Yeah.
The thrift savings plan is a pretty good retirement plan. The fees are very low. The diversification, pretty good. And you get a bond fund that nobody else can get.
Yeah, and these variable annuities, this according to Ron Lieber in the New York Times, said that the surrender fee is 8.5%.
That's the commission the salesperson
and
gets.
The annual fees start at 2.55% annually.
And in the TSP, you're probably paying
0.1% or less?
Very, very, very
or
low.
less?
Yeah, very low.
Now, an attorney for the firm sent a press release out accusing the SEC of defamation and bullying.
I hope they're bullying them.
And they didn't know about their colleagues doing this bad stuff. No. The website makes it appear that they are a federal agency helping you manage your retirement plan. You even have to enter a FedTracker you request a FedTracker authorization code.
There is no federal agency that is doing this, just so you know. There isn't any.
Can you say con?
Oh, it's just outrageous. 200 people that took their money out of a very low-cost, widely diversified retirement plan and moved it into an annuity that, as you said, probably charges, 2.5%, but then you got to add the fund expenses in, et cetera, et cetera.
So I was poking around in the MyFEBC website, the Federal Employee Benefit Counselors, and I read their about statement.
Yeah.
It says Federal Employee Benefit Counselors is a national consulting group dedicated to educating federal employees. FEBC was founded by certified financial planners with a mission to help federal employees understand and optimize their complex benefits package.
By the way,
they do it all for free.
Yeah, right. This is an important point because oftentimes people believe a certified financial planner has to do the right thing by you. No, that's not true. That's a designation that you earn, which means you do have some knowledge about the business.
Actually, though, no. The CFP board, the Certified Financial Planning Board, does have a code of ethics.
I know they do.
And these guys are violating, if they're doing what the SEC claims they're doing, then they're violating every tenet the Certified Financial Planning Board stands for. So, by the way, if you're a certified financial planner and you're listening to the show, you should be all over your CFP board to take these people down.
I agree.
Because they're denigrating, they're diminishing your designation by selling people variable annuities inside a retirement plan.
And taking them from a very low-cost provider and putting them in an outrageously expensive retirement. Yeah, that's nuts.
These guys sell annuities. They totally sell annuities.
But it's educational.
Of course it
Educational annuity. Hey, we're on to something.
They're a member of FINRA, which means they're a broker-dealer. They're also, they're insurance agents. Gee, what a surprise. Okay, let's go back to the phones. I forgot who's next.
Larry.
Oh, good. Thank you for remembering. Larry, welcome to Talking Real Money.
Hey, Larry.
Thank you. I have a question about some exchange-traded funds. One of the funds is FSD, and it's in the First Trust family of funds.
We're going to look it up.
All right. What's your
the
question?
Other one, pardon me?
Oh, go ahead and give us the other one.
Okay. And the other one is HYHG, and it's in the ProShares fund.
Yeah, okay.
And I want to know what you folks think about these as a investment.
Those are the antithesis of what an ETF should be. They are the kind of ETFs that we think give the industry a really horrible, bad, nasty name. The First Trust High Income Long Short Fund, its name says it all. We're gambling with high-yielding bonds, and we think we know the future, so we're going to go long or short.
And let's pull that apart a little bit. A higher-yielding bond is issued by a company or governmental agency that looks riskier than another one, right? That's because you're going to pay a higher interest rate.
Right now, they own 122% of the portfolio.
Yeah, because they're long.
122% of the portfolio is in junk bonds.
Do you understand what a junk bond is, Larry?
Well, not completely, but I know it's a high-risk bond.
Yeah, I mean, these are, again, issued by corporations that have to pay a higher interest rate because they may or may not pay you back at the end of the day. That's really what junk is.
Their portfolio is, and bear in mind, they borrow to buy them.
Yeah.
They are 92% in corporate bonds. Of those corporate bonds, of the entire portfolio,
Let me guess. 70% BB, or some high number.
Worse. 80%, 85% are junk.
Wow.
85% of the portfolio is junk. So your risk is comparable to the risk of an equity
stock
fund.
Portfolio, yeah.
Because there's a default risk.
Well, no, it's higher than a stock portfolio because you're borrowing money to buy them.
Because you're borrowing money to buy them.
You're taking more risk.
This is a high-risk bond fund. It is actively managed. ETFs.
The whole premise of the originally.
What was the second one?
The second one is HYHG. But the whole premise of an exchange-traded fund, the idea behind them was this is a way to own an index-like investment that you can trade during the day. That's where they all started. And then once the doors were, people thought, I want to have some of those. Then they started selling things like FSD because, I want an ETF, not realizing this is actively managed and taking a lot of risk.
Owning these two together is hysterical because the first fund, which was
FSD first.
Yeah, the FSD. The first fund is 122% in junk bonds.
So now you're taking a lot of risk on the bond side.
The second one is the ProShares High Yield. Okay, that's another junk bond fund.
It is.
But they're 97% in cash.
So they're betting the other way. They think we're in for a downfall of
right.
So these are people believe in timing.
So you're paying somebody to manage your money to keep it in cash
until they feel like things look better, which
feelings.
I didn't know things could look a whole lot better than they did right now.
Feelings.
As corporate earnings are up. I mean, you have that general.
Tell you nothing.
So you're making one bet.
Don't rely on feelings.
One big bet saying junk bonds look great. One big bet saying they look bad, like Don singing.
Feelings.
So, I mean, this is not a portfolio you would recommend. If you're going to own one ETF, by the way, I just go own VT.
VT is just the stock market.
That owns a globally diversified portfolio of a large basket of stocks.
And they never try to predict the future. Yeah. Feelings really.
Did that give you the answer you were looking for?
Go ahead.
Did that help in any way, shape, manner, or form?
Yeah, it did, and also told me you shouldn't give up your day job for singing.
Thank you.
You had that coming, Larry. That's good. I like that.
That's why. That's why I do talk radio.
Exactly. We don't. Operatic Don McDonald will return to Channel 73 on Sirius XM.
You notice you didn't see me on America's Got Talent ever because I ain't got no talent.
Larry, thank you for your call. So, I mean, an ETF is simply a vehicle. It has nothing to do with being an index. You can buy ETFs like this. You can buy ETFs that are index-like, but don't get confused because I think people hear that and they think, aha, that's like an index fund. No, these two are decidedly not index funds.
And what's hysterical is that you've got two groups of professional managers.
Have completely opposite views. Yeah.
With completely different feelings.
And by the way, if you really want to look at risk, there's a lot of people. We talked a little bit about this at the beginning of the show. There are a lot of people. The voices are very loud right now that the bond market is about to blow up. So if you're buying bonds, I know you're getting mad at me.
They've been saying that for years.
At least 3 years. But if you're buying bonds using borrowed money, guess what's going to happen to that portfolio when these type of bonds decrease in value?
Well, but then if you own the ProShares High Yield Fund, you'll be covered because it won't go down.
That's a good point. Won't go up either, but it won't go down.
It literally cannot go up.
No, it's stuck in cash.
It cannot go up in value, period, exclamation point. I wonder what its performance is.
That, by the way, is a clear sign of what investing versus speculating is. Both of those funds, both of those exchange-traded funds, are speculative. They're making bets on which way the market's going. They're making bets that these firms will continue to pay their high interest loans, if you will, and investing is not that.
And you want some hysterical performance figures? That one that's in cash. In 2014, they lost 4%.
Yeah.
In 2015, they lost 10%.
Oh.
But in 2016, they made 16%.
There you go. All
over the board.
Yeah, crazy.
Dangerous danger, Will Robinson. Remember that show?
No
You're
more
old.
singing.
Come on.
I don't.
That was Lost in Space. Be right back.
Tom and Don are talking real money.
Quick break. In addition to our Talking Real Money podcast, we have a few other tools to help you gain a better understanding of the concept of real investing. Of course, there's Real Investing Journal. That's offered in both a free online version and in an inexpensive printed magazine. Explore both those options at realinvestingjournal.com, realinvestingjournal.com. Then we teach classes. We offer most of our live classes in the Seattle area because that's where most of our offices are, but most of you live elsewhere. That's why we're now offering the same classes that Tom and I taught at Retire Meet online right now, free at talkingrealmoney.com under the video link. Just go to talkingrealmoney.com and then click on the video link. You'll see them right there. Finally, we also manage the wealth or the budding wealth of hundreds of folks like you through our fee-only 100% fiduciary investment advisory firm, Vestory. You'll find our approach is consistent with the message we've been sharing for decades. We always put our clients' needs first. Our fees are among the lowest of any non-robo advisor, and constant education is one of our core values. Visit Vestory.com for more information on our firm and to take our free no-obligation risk quiz to better understand the level of investment volatility you can tolerate. That's Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
And do not forget, Tom and attorney Richard Gregorek get together on August 29th for an exciting rendition of Retirement Freedom. Learn how to invest for retirement and protect those assets from all those bad things that might happen. And it's a really, really good class, and it's dirt cheap. Just get your tickets right now at talkingrealmoney.com, talkingrealmoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.